We all can agree that macro trading strategies is a legitimate and it's one of the most complex and intellectually demanding forms of investing in the financial world. Unlike stock pickers who try to guess which tech stock will explode next week, or value investors trying to predict which high-quality tech stock going to the moon, macro traders bet on economies and industries, not just companies. They analyze everything economy and try to predict the big turning points in the global financial system. They look for macroeconomic shifts, booms and busts, interest rate hikes, inflation waves, debt crises, currency collapses, commodity shocks, and even wars. And of course, if they get it right, they can make billions. We got George Soros, the man who broke the Bank of England. In 1992, he realized that the British pound was overvalued and couldn't stay in a European exchange rate mechanism. So he shorted it. Hard. The result? $1 billion in profit. In one day. Then there's Stanley Druckenmiller, Soros's right-hand man. He called the German reunification trade perfectly and later predicted the dot-com crash and the 2008 financial crisis, all while maintaining one of the most consistent track records in hedge fund history. And of course, Ray Dalio, the founder of Bridgewater Associates, the largest hedge fund in the world. His entire investing approach revolves around identifying long-term global economic patterns, using frameworks and first principles he developed and documented like a financial philosopher. But here's the truth. These macro legends didn't just have a feeling, and they definitely weren't winging it based on vibes and a chart someone posted on Twitter. Their success was rooted in discipline, data, and decades of experience. They had entire teams of analysts and economists working around the clock, dissecting every shred of global economic information. They had access to real-time, institutional-grade macroeconomic data, the kind of data that retail traders can only dream of. They weren't reading headlines on CNBC. They were reading unpublished central bank research and occasionally having private conversations that most people will never even know took place. Their edge came from years of pattern recognition, understanding how interest rates, inflation, capital flows, and political developments interact across markets. More than anything, they had a framework, a structured, repeatable way of understanding how the world actually works. That's what made them great. And then, we got the macro specialist on Reddit, the guy who just learned what a yield curve is yesterday. Now think you're ready to short the Japanese yen because of a meme titled, "Why Japan is the next domino to fall, and how to 10x before lunch." The post was written by someone named Macromamba420, who has an anime profile picture, no last name, and cites AI indicator as his primary macro indicator. But you didn't care. The meme had arrows, bold red text, scary-sounding economic terms like debt to GDP, and a grainy screenshot of a Bloomberg terminal that could have easily been made in Microsoft Paint. Next thing you know, you're opening a 50x leverage position against the yen on a trading platform with more spelling errors than disclaimers. You're muttering phrases like carry, trade, unwind, while your cat stares at you with growing concern. You don't even know what a carry trade is, but deep down, you believe this is exactly how Druckenmiller got started. Then nothing happens. The yen doesn't crash. In fact, it strengthens. Violently. Your position starts bleeding faster than your confidence. You're refreshing your trading app every 2 minutes, whispering, "Codicin, please stop," like you're begging the monetary gods for mercy. By lunchtime, you're not 10x richer. You're 80% poorer, sitting in the dark, eating instant noodles, and wondering how the Bank of Japan personally manipulated your destiny. You open Reddit, write a 700-word post blaming shadow banks and the Illuminati that don't want to let the little guy win. Now here's the thing. If you're a retail trader sitting in your pajamas with 3 open Reddit tabs, you don't have access to central bank whisper networks, the informal, behind-the-scenes conversations that move trillions before the public even gets a press release. You're not getting text from someone at the ECB saying, "Hey, we might nudge rates next Thursday, FYI." You also don't have teams of building complex models that track global liquidity, sovereign debt flows, and interest rate sensitivities across 30 economies. You might have a Google Sheet with conditional formatting. That's not the same. You don't have real-time economic data terminals like Bloomberg or Icon, the ones that cost more than your car and come with live updates, analyst coverage, and tools that make Excel look like a stone tablet. And most importantly, you don't have a repeatable macro framework, just a Twitter feed full of hot takes, crypto bros yelling about inflation, and one guy named Fed Hunter who claims he predicted 2008 crash. No proof, of course. The harsh truth? You have none of the tools, none of the team, and, if we're being honest, no idea what you're doing. But you're out here trying to trade against hedge funds and central banks like it's Call of Duty, Currency Edition. This is why most people should avoid making economic prediction and should just invest their money in an index fund or mutual funds. Then you got the commodity cycle traders. Being a commodities trader isn't just looking at an oil chart and yelling buy the dip. It's waking up at 3 a.m. because some obscure pipeline in Kazakhstan exploded, and now Brent crude is spiking faster than your heart rate. It's staying glued to weather forecasts like a deranged meteorologist, because a drought in Argentina might nuke your soybean trade. These people aren't just looking at charts. They're tracking rainfall in Brazil, wheat fungus outbreaks in Ukraine, OPEC's mood swings, and shipping rates out of Singapore. They know the sulfur content of 15 different grades of crude oil. You're out here struggling to find the RSI indicator on TradingView. One moment, you're long natural gas because winter's coming. The next, some diplomat blinks in a Europe-Russia meeting and gas prices drop 20% before you finish your coffee. Commodities are affected by everything. Geopolitics, climate change, logistics, strikes, pandemics, storage capacity, even rats eating cocoa in a warehouse. Yes, that's happened. It's not trading. It's warfare. And here you are, thinking you'll outtrade Glencore because you watched a 5-minute YouTube video called Why Silver is the Most Undervalued Asset on Earth. Commodities traders don't guess. They survive. You don't get rich in commodities. You claw your way through chaos and pray you break even. So unless you're ready to live inside a Bloomberg terminal, memorize shipping routes, and start calling farmers in Iowa to verify corn yields, maybe stick to paper trading. Or at least stop yelling oil every time the price pops 5%. In short, macro trading is like playing four-dimensional chess while blindfolded on a boat in the middle of a storm. Done right, it's pure genius, a masterclass in prediction and timing. Done wrong, it's disaster. You don't just lose money. You end up on Reddit, ranting in all caps about how Jerome Powell personally ruined your weekend and Margin called your all-in on Japanese yen thesis. With that, this is Visionomics, signing out.